If you're new to trading, or even if you've been at it for a little while, you've probably heard the statistics. A significant percentage of new traders lose money. A big reason for that is a series of common, often avoidable, mistakes. In this video, we are going to take you through the top 10 mistakes beginner traders make. And, believe me, they regret them later in life. We're not just going to list them, we're going to explain why they're so detrimental. So, grab a notepad, settle in, and let's get started. Mistake number 1. Trading without a plan. The very first, and perhaps most devastating mistake, is trading without a well-defined plan. This isn't just about having an idea of what you want to buy or sell. It's about having a comprehensive strategy that dictates every aspect of your trading. Think about it. Would you build a house without blueprints? Would you go on a long journey without a map? Of course not. Yet, countless beginner traders jump into the market with little more than a hunch or a tip they heard somewhere. A proper trading plan outlines your entry criteria. What specific conditions need to be met before you even consider entering a trade? It defines your exit strategy. When will you take profits? And more importantly, when will you cut your losses? What's your risk per trade? What markets will you focus on? What time frames will you trade? Without these answers, you're essentially gambling. You're reacting to market movements emotionally rather than executing a pre-planned strategy. This leads to impulsive decisions, chasing trades, and letting small losses spiral into significant ones because you never defined your exit point. The regret here comes from realizing how much money was lost due to chaotic, reactive trading that could have been avoided with a simple framework. Later in life, they look back and see a pattern of inconsistency and emotional swings, all stemming from this fundamental lack of structure. Mistake number 2. Overleveraging. This one is a massive trap for beginners, especially in markets like Forex or futures where high leverage is readily available. Overleveraging means using borrowed capital to amplify your trading position beyond what your actual account balance can safely support. Imagine you have $1,000 in your trading account. With 100 to 1 leverage, you can control a position worth $100,000. Sounds great, right? You can make huge profits with a small initial investment. The problem is, leverage works both ways. A small move against your position can wipe out your entire account, and then some, if you're not careful. Beginners, fueled by the desire for quick riches, often take on far too much leverage, believing they've found a sure thing. They might see a small initial profit and get overconfident, increasing their leverage on subsequent trades. Then, a sudden market swing, or even just a bit of volatility, can lead to a margin call, or, worse, their account being completely blown out. The regret isn't just about losing the initial capital. It's about the financial and emotional stress of being in debt to a broker, or the crushing realization that their trading journey ended almost before it began, all because they were too eager to magnify their gains without understanding the magnified risk. They often regret not starting small, understanding risk, and building their account slowly and sustainably. Mistake number 3. Lack of risk management. This ties closely with overleveraging, but extends beyond it. A lack of proper risk management is a fatal flaw. It's the failure to protect your capital and control your potential losses. Beginner traders often focus solely on potential profits, completely neglecting the possibility of losses. Risk management involves several key components. Firstly, defining your risk per trade. How much of your total trading capital are you willing to lose on any single trade? A common rule of thumb is to risk no more than 1 to 2% of your account on any given trade. So, if you have a $10,000 account, you wouldn't risk more than $100 to $200 per trade. Secondly, using stop-loss orders. A stop-loss is an order placed with your broker to automatically close your trade if the price moves against you to a pre-defined level, limiting your potential loss. Many beginners either don't use stop-losses at all, or they set them too wide, or they move them further away when the market approaches, hoping for a reversal, a practice known as hoping and praying. This emotional decision-making, driven by fear of realizing a loss, almost always leads to larger losses than anticipated. The regret is profound. Seeing an account dwindle or vanish because they failed to implement basic protective measures. They later realize that consistent profitability comes from managing losses effectively, not just from picking winners. Mistake number 4. Chasing hot tips and gurus, the easy money illusion. In the age of social media, everyone's an expert. Beginner traders are particularly susceptible to the siren song of hot tips, insider information, or guaranteed returns promised by self-proclaimed gurus. They join Telegram groups, follow flashy Instagram traders, or subscribe to expensive newsletters, believing that someone else holds the secret key to financial freedom. The reality is, profitable trading requires independent thought, diligent research, and developing your own edge. While learning from experienced traders is valuable, blindly following signals or tips without understanding the underlying analysis is a recipe for disaster. These gurus often have ulterior motives, whether it's selling you a course, getting you to sign up with a specific broker where they earn commissions, or simply boosting their own ego. When these tips inevitably fail, as they often do, the beginner trader is left with a lighter wallet, shattered confidence, and a deep sense of betrayal. The regret isn't just about the money lost on bad trades or expensive subscriptions. It's about the lost time, the misplaced trust, and the painful realization that there are no shortcuts to success in trading. They regret not focusing on their own education and development rather than relying on external, often dubious, sources. Mistake number 5. Overtrading. Many beginner traders believe that the more trades they place, the more money they'll make. This leads to overtrading, taking too many trades, often without proper justification, or trading simply for the sake of being in the market. This mistake stems from several factors: impatience, boredom, the desire to make up for a previous loss, or simply not having enough high-probability setups. Each trade incurs commission fees and spreads, which eat into your profits. More importantly, overtrading often means taking lower-quality setups. Instead of waiting for their well-defined trading plan to generate a signal, beginners might force trades, convinced that they have to be in the action. This usually results in small, frequent losses that quickly erode their capital. They might also hop from one strategy to another, unable to give any single approach enough time to prove its efficacy. The regret comes when they analyze their trading journal, if they even keep one, another common mistake, and realize that their most profitable periods were often those when they traded less, focusing on quality over quantity. They regret the constant grind, the emotional exhaustion, and the accumulation of small losses that could have been avoided by simply being more selective. Mistake number 6. Not keeping a trading journal ignoring their own data. This is perhaps one of the most overlooked yet critical mistakes. A trading journal is your most powerful tool for self-improvement. It's a detailed record of every trade you take, including date and time. When did you enter and exit? Asset. Traded. What did you trade? Entry and exit price. What were your exact prices? Position size. How many units or lots? Reason for entry. Why did you take this trade? What criteria were met? Reason for exit. Why did you close the trade? Did you hit your stop loss, take profit, or something else? Profit loss. How much did you make or lose? Emotions. How were you feeling before, during, and after the trade? Were you confident, fearful, greedy? Lessons learned. What could you have done better? Beginner traders often skip this step, viewing it as tedious or unnecessary. Without a journal, you have no objective way to analyze your performance, identify your strengths and weaknesses, or track the effectiveness of your strategy. You're flying blind. You might repeat the same mistakes over and over without even realizing it. The regret hits later when they realize they've been stuck in a cycle of losing, unable to pinpoint why. Because they never bothered to collect the data. They regret not having the information to make informed adjustments to their trading plan, and thus missing out on crucial opportunities for growth and profitability. Mistake number 7. Emotional trading, letting feelings rule their decisions. Trading is a highly emotional endeavor, and beginner traders are particularly susceptible to letting their emotions dictate their decisions. The two biggest culprits are fear and greed. We have talked about these issues a lot in our previous videos, but they're worth repeating. Fear. Fear can lead to premature exits from winning trades, taking small profits too soon, or paralysis that prevents them from entering valid setups. It can also cause them to widen stop losses or avoid setting them at all, fearing a realized loss. Greed. Greed manifests as holding on to winning trades for too long, hoping for just a little more profit, only to see the market reverse and wipe out gains. It also drives overtrading, overleveraging, and taking on excessive risk. Beyond fear and greed, frustration, impatience, and the desire for revenge trading, trying to get back at the market after a loss, are also common. When you trade emotionally, you abandon your plan and react impulsively to market fluctuations. This inevitably leads to inconsistent results and significant losses. The regret here is multifaceted. The financial loss, certainly, but also the self-reproach for not being disciplined, for letting their feelings sabotage their logical analysis. They look back and see how many good trades were ruined and how many bad trades were taken, all because they couldn't control their psychological state. Later in life, they understand that mastery of trading is as much about mastering oneself as it is about mastering the charts. Mistake number 8. Not backtesting or paper trading, jumping into live too soon. Backtesting and paper trading, also known as demo trading or simulated trading, are absolutely essential steps that far too many beginners skip. Backtesting involves applying your trading strategy to historical data to see how it would have performed. This allows you to identify strengths, weaknesses, and potential pitfalls of your strategy before you risk real money. It helps build conviction in your plan. Paper trading involves trading with virtual money in a simulated environment. It allows you to practice executing your trades, managing risk, and following your plan in real time without any financial risk. It's like a flight simulator for traders. Beginners often skip these crucial steps because they're eager to make real money. They don't want to waste time with fake money or looking at old charts. This impatience leads them to deploy an untested strategy or to try to trade live without having developed the necessary muscle memory for executing their plan. The result is often a quick and painful loss of real capital. The regret is knowing they could have learned invaluable lessons and ironed out the kinks in their strategy for free, but instead, they paid for those lessons with their hard-earned money. They regret not building a solid foundation and instead rushing into the deep end without knowing how to swim. Mistake number 9. Ignoring macro and fundamental factors. While technical analysis, studying charts and price patterns is incredibly powerful, relying solely on it and ignoring broader macroeconomic factors or fundamental news events is a significant oversight for beginner traders. Major economic announcements like interest rate decisions, inflation data, employment reports, geopolitical events, or company-specific news, earnings reports, product launches, mergers, can have a massive and immediate impact on market prices, often overriding any technical indicators. For example, a perfect technical setup for a stock might be completely invalidated if the company announces surprisingly bad earnings. A perfectly charted currency pair might react wildly to an unexpected interest rate hike. Beginner traders, often absorbed in their charts, might be blindsided by these events, leading to unexpected losses or missed opportunities. They might not understand why a strong technical pattern suddenly failed. The regret comes from realizing that they were operating in a vacuum, ignoring the larger forces that move the markets. They regret not taking the time to understand how economic cycles, central bank policies, and global events influence asset prices, leaving them vulnerable to sudden shifts that could have been anticipated with a broader perspective. Mistake number 10. Giving up too soon. Unrealistic expectations. Finally, and perhaps most heartbreakingly, many beginner traders give up too soon because they have unrealistic expectations. They enter the market believing they will become overnight millionaires, seeing trading like they are buying a lottery ticket that would make them buy their dream cars or house next tomorrow, rather than a skill that requires dedication, discipline, and continuous learning. When they inevitably encounter losses, setbacks, or periods of stagnation, which are all a normal part of the trading journey, they become discouraged and quit. They might blame the market, their strategy, or even their broker, rather than looking inward at their own process and mindset. Trading is an endless improvement of oneself, because the market is going to reveal all your psychological weaknesses. So, it takes a tremendous amount of time to develop a profitable edge, to master your emotions, and to build a robust trading plan. There will be losing streaks, drawdowns, and periods where your strategy doesn't perform as expected. Successful traders view these as learning opportunities, not reasons to abandon ship. The regret for those who quit too soon is the missed potential. They later see others who persevered, learned from their mistakes, and eventually achieved their trading goals. And they realize they gave up just before they might have turned the corner. They regret the lack of patience, resilience, and the belief that success should come easily, leading them to abandon a potentially lucrative path prematurely. So, these are all the 10 critical mistakes that most beginner traders make and regret later during their trading journey. This isn't meant to discourage you, but rather to equip you with the knowledge to avoid these common pitfalls. Remember, Every successful trader has made mistakes. The key is to learn from them, adapt, and keep moving forward with discipline and a commitment to continuous improvement. Take these lessons to heart, implement proper risk management, develop a robust trading plan, and most importantly, treat trading as a serious business, not a game. If you found this video helpful, please give it a thumbs up, subscribe to the channel for more trading insights, and let me know in the comments below which of these mistakes you've personally encountered or are working to avoid. Thanks so much for watching our videos, and I hope to catch you up in the next one. Love you and love trading. Thank you!